Hey everyone, and welcome back to the channel. Today, we're tackling the million-dollar question on every prospective homebuyer's mind: will mortgage rates finally drop this December? It's been a roller coaster of a year, and with the holidays just around the corner, many of you are wondering if waiting a little longer will save you a lot of money. So, let's dive deep into what the lending experts are saying and what it all means for you. First, let's set the stage. Throughout this year, we've seen mortgage rates climb to levels not seen in over 2 decades. This has been a major headache for anyone trying to buy a home, squeezing affordability and pushing many people to the sidelines. The primary driver behind these high rates has been the Federal Reserve's aggressive fight against inflation. They've been raising their key interest rate, the federal funds rate, which makes it more expensive for banks to borrow money. Naturally, banks pass these higher costs on to consumers in the form of higher rates on mortgages, car loans, and credit cards. So, the big question is, what's different about December? Why is there a glimmer of hope now? Well, there are a few key factors at play. The most significant one is inflation. Recent data has shown that inflation is finally starting to cool off. It's not back down to the Fed's target of 2% yet, but the trend is moving in the right direction. We're seeing prices for certain goods and services stabilizing, and some are even coming down. This is a huge deal because if inflation continues to ease, the Federal Reserve will have less reason to keep hiking its rates. In fact, they might even decide to pause their rate hikes, which would be a major signal to the market. This brings us to the Fed's next meeting, which is scheduled for mid-December. This meeting is circled on every economist's calendar. The market is overwhelmingly expecting the Fed to hold rates steady. They'll be looking at the latest inflation reports and jobs data right up until their decision. A strong jobs report might suggest the economy is still running hot, giving them a reason to stay hawkish. On the other hand, signs of a slowing labor market, combined with lower inflation, would strongly support a pause. A pause doesn't mean rate cuts are imminent, but it stops the upward pressure on mortgage rates and creates a more stable environment. It's important to remember that the Fed's rate isn't the same as the mortgage rate, but it heavily influences it. Investors in these bonds are constantly trying to predict the future of the economy and the Fed's actions. When they anticipate that the Fed will stop hiking rates, or even start cutting them in the future, the yield on these bonds tends to fall. And when Treasury yields fall, mortgage rates typically follow suit. Lately, we've seen some of this happening already. The 10-year Treasury yield has pulled back from its recent highs, and as a result, mortgage rates have also dipped slightly from their peak. Many lending experts are predicting that if the upcoming inflation data remains favorable, over the life of the loan, that adds up to tens of thousands of dollars. However, we need to inject a dose of realism here. The experts are clear: a gradual decline is the most likely scenario, not a sudden drop. The economy is still navigating a very complex environment. There are global uncertainties, and the U.S. economy, while slowing, has been surprisingly resilient. The Fed wants to be absolutely sure that inflation is under control before they even think about significantly cutting rates. Typically, the winter months see a slowdown in real estate activity. There are fewer listings and fewer buyers. This can be a double-edged sword. On one hand, less competition from other buyers could give you more negotiating power. On the other hand, the inventory of available homes might be more limited, so you might have fewer options to choose from. So, what's the takeaway for you if you're thinking about buying a home? The key is to be prepared, but also patient. First, get your finances in order. This is non-negotiable. Work on improving your credit score, because a higher score will always get you a better interest rate, regardless of what the market is doing. Second, start talking to a mortgage lender now. That perfect house might not be on the market when rates finally do fall. Let's recap the expert consensus for December. The overall sentiment is cautiously optimistic. We are likely past the peak for mortgage rates in this cycle. Favorable inflation data and a likely pause from the Federal Reserve are expected to allow rates to soften and drift downwards. We could see 30-year fixed rates moving into the low 7% range, with an outside chance of dipping into the high 6% range by year-end. However, a dramatic plunge is highly unlikely. The process will be gradual. My advice: stay informed, but don't get paralyzed by the headlines. The housing market is hyperlocal. What's happening on a national level is important, but what matters most is your local market and your personal financial situation. Work with a trusted real estate agent and a knowledgeable mortgage lender who can guide you through the specifics of your area. They are your team on the ground. This December could present a window of opportunity for well-prepared buyers. I hope this breakdown gives you a clearer picture of what to expect in the coming weeks. And I'd love to hear from you in the comments.